This is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, February 16th, 2024. It is 9:50 a.m. Eastern Time, so I wanted to get this one out a little earlier just to share my thoughts. We've been waiting we've had one minor sell signal for an active trade, a pullback trade recently, and I've been talking about them repeatedly daily, these next more significant, more powerful sell signals, which would be either an entry for a swing short position or an add-on if you took the initial breakdown there and waiting to bring it to a full position. I got to say, I'm liking what I'm seeing now. This market has been bulletproof, and I just want to reiterate. I think 2024, I see, and it may not pan out. I know I talk about these things, a tremendous opportunity to profit, shorting the market, going long the VIX, things like that. And again, it has to do with all of everything I've covered. And if you're new to the site, that includes, but not limited to, some of the most extreme and persistent deterioration in market internals, meaning just a handful of stocks, fewer and fewer doing the lifting. There's I haven't talked much about this, but almost a scary, if you will, for lack of a better word. I don't try to be dramatic, but almost a scary disconnect between credit spreads right now. They're virtually nil, and that shocks me because right now, let me just summarize everything. This market is 100% priced for perfection. They've been, the bull case has been singing this Goldilocks scenario. It went from hard landing, maybe will be a hard or soft landing, to then would it be a soft or no landing, in the vast consensus. Again, depending on where you get your news source from and your information. If you're at CNBC, it's bubble TV, I call it. It's pretty much the camp is in the no landing scenario. And I couldn't be farther from that. I'm in the very hard landing. And again, maybe I'm wrong, but here's the thing. We're going to, the way I trade, I'll tell you my views. I'll tell you where I think something's going. But until you have a buy or a sell signal, if I'm bullish on something, you need a buy signal. Now, sometimes I'll get in early. Sometimes I'll build positions. But as I mentioned the other day, started to build swing positions. And I'm going to press those pretty hard once this level goes here. I expect it to go. I'm going to, and so here's what's going on fundamentally, guys. So the market has priced in fully and then some by from and on a fundamental basis, earnings, everything else, that you're going to get that Goldilocks scenario, that rates are only going to go down, that it's guaranteed, and they're going to go down a lot. And I've been saying for a while, that's done this a long time. When everybody thinks the same thing and everybody's positioned for the same thing, that thing almost never happens. It's almost like, how in Vegas, I'm not a gambler. This is my form of gambling. It's, there's speculation involved, but it's calculated odds and all that. When you go to Vegas, as you know, every single game in the casino, maybe other than poker, if you're a very good poker player, but all the other games, from blackjack to the one-armed bandit to, all of it, roulette, they have definitive odds. You can look up those odds. Even blackjack has odds there, and they can vary. You can be a better or worse player, but my point is the house has to win. They're always going to win, and that's kind of the same with the financial markets. You can't let the masses win. Anyway, at times. So all right, let me get off that. But here's what we're seeing lately. I've been warning of this, that hey, everyone thinks rates are going down. What if they go up? So let me just start with going back to this. This is, I think one of the most important and simplest charts that I've posted in quite a while. And who knows, maybe I'm wrong on it, but so far it's spot on. So this is my, before we even enter the yellow zone, there's the yellow zone. Stock market starts to take note of rising yields, which it most certainly has. Again, the day we dropped into it was not mere coincidence. That was the worst day the Dow had in almost a year, right? And we caught it. We were short. We had a sell signal ahead of time in anticipation of based on the breakdowns on the intraday charts of the equity markets. And then that followed. Yesterday, reiterated and repeated that it was an objective short because we were back testing. Remember, once support. This was support. That's why that yellow zone wasn't there random. Then I just picked an area on the chart. It was a key support level we've been flirting with. And so we dropped into it, which again, remember, when IEF, the 10-year bond's dropping, it means yield's going up. So then there was an abatement. Everybody the next day, and even folks on the site dismiss as a one-off. It doesn't matter. Market's too resilient. Even the headlines. I mean, I get the journal barons, read other sources, and they're just as a one-off. And like I said, it was only a slightly hot CPI number. But today the PPI came out. PPI was hot too, pretty hot. And on top of that, so that what that does is it doesn't eliminate, but it just reduces the chance or magnitude of the rate cuts that we're going to get. And we're going to get them. That I can guarantee. We're going to get them because the economy is going to start to tank soon. Leading indicators tell me that's not just me with witchcraft and looking at a crystal ball. All the leading indicators. There's just such flawed economic data out there right now, and then so many of these, pimple-faced kids coming out of college. No offense, guys, to the young folks listening, but that haven't lived through these cycles and are going off classical things taught to them in business school today, and they're looking at and putting a lot of faith into concurrent indicators and things that really don't have predictive value. You really got to lift up the hood. It's gotten more complicated in recent years, and the government has gross distortions they make, even to the jobs data. If you don't know this, they use the birth-death model. It kind of projects. It's not actual. When you're getting the jobs data from the government, it's kind of a hypothetical, not an actual. But anyway, and remember, if you thought it was perfect data, and let's assume it was, that is a concurrent or coincident indicator. Every recession, every stock market top happen at the big ones, the bear market, at record low unemployment. It turns first, and then it turns fast when it does. So anywho, that's what I see coming later. But so today, what my point was, Wednesday, as I warned you, there's a heavy economic calendar this week, and if things were going to turn this market, there was a lot in there that could. So boom, CPI was a shot across the bow. Again, as I said and expected that day, the dip buyers, Pavlov's dogs, as they are conditioned, bought. They bought the trend line, and that was the only trade to make at the end of the day. Either cover that short and or go long, or wait if you want to swing it down. I talked to the swing trader as well as the active trader. Hold off, wait for the trend line breaks, and then you can add to a starter position that you took on Tuesday when we got the sell signals. Okay, so let me end it here. I always say this. You hear me say this all the time. One day doesn't make a trend, and that means Wednesday. 2 days doesn't make a trend, but what I am seeing is what I predicted and figured would be likely, and wasn't a hard prediction. It was kind of hey, this is a good chance this could happen because nobody thinks it could, and that's rising yields, and then the and by the way, guys, what you're seeing is on all these economic reports. The market is rallying on bad economic data. Yesterday was retail sales. The market rallied on that. It was worse, much worse than expected. Some really bad numbers there. And so it's in Seinfeld episode. Remember if you were a Seinfeld fan, they did the one with Bizarro World where he gets it from Superman, I think, or something, and everything's backwards. So right now the market's been rallying, hoping for bad economic data, just because it's all so dependent on rates. All right, let me get off that. Let me just go over levels, and I'll shut up and get through the video here. So there it is, boom, knocked down again. Nothing more. We're back to where we were the other day. But that's important, and I mocked up a chart. I was going to get out to you, and then I figured I'll do the video here. Let me grab it 1 second. Okay, so this is it. This was this morning, right after the open. You can see I screenshot it immediately. We broke down yesterday. I gave you the same. I'm sorry, this was in the comments section, and I 5-minute charts is active trading stuff. It doesn't warrant its own dedicated homepage post. So as I said, if you're an active trader, come in those comment sections. You can subscribe to any one of them. So if there's a new post update, you should get an email. There was a breakdown. Well, no. First of all, yesterday I said objective entry 1 right here at the back gap fill. There's the gap. See, that's where we close. This whole thing is the gap. That is a 10 on a scale 1 out of 10 for an objective short. And remember, I defined that yesterday. You hear me use these words. When I say something's objective, it's objective long entry or objective short entry. That isn't necessarily. It's not mutually exclusive, but it is not necessarily the same as a high probability entry. Objective is just that. Take that word on face value. That's all it is. Doesn't mean it's going to pan out, but when you're especially with negative divergence and expecting a reversal and you rally into resistance, that's objective, as would be a breakout above resistance for an objective long. Again, now that wouldn't be a high probability entry. That would be a breakout that I would put odds would fail because of the negative divergence and the overbought conditions, but it's objective. High probability entry is going to come when we take out those trend lines. So I'm going to get to that in 1 second. So that's it. And so this was this morning. We were right. We hit it again. So if you missed that entry, or you missed the breakdown there, or you missed, as I said, and I put a post in the comment section yesterday, we hit the first. That was the same line I had there, 433.56. We hit it to the button. We bounced. And I posted right yesterday the near back test there. And so that's it. There's the full back test. That's a double resistance. So if it's objective to short for a kickback to 435, which is the top of the gap, which it is, it's twice as objective, or not twice as objective, but even better when it's also coincides, that 435 level coincides exactly with a back test of the wedge. So there was that's what I call a high probability entry this morning at the open. Now, again, I decided to do the video, so you know what I did? I'm sorry, I might have posted that in the under the yesterday's comment section. So now let's look at that. So, and of course, you're in here too in the yellow zone. So any bounce back, as I said 2 days ago, and since is an objective short entry. But when you go to QQQ, look at the 5-minute chart. There it is. This is what I do, and this is when I get excited because the charts are really setting up where no breakdown yet. Well, I'm going to get to it. We're getting we got a little work to do, but even for active traders, and again I've said this, I don't encourage anyone to use leverage products I don't encourage anyone to do anything. You can use this site as a learning resource. That's what I consider it as. I share what I've learned the hard way over the years. Tips, tricks, strategies, what I'm doing, incorporate it with your own analysis, with that of others. These are, what I'm getting at, if you're actively trading, and that's what 5-minute charts really used for mostly, is active trading, and you're trading futures. And let's say you came into the day empty, or you only trade QQQ. You don't do futures. You don't have an account. You don't understand how they work, but you trade, this morning at the open. And again, I did post it. You had that objective short entry, made 1% in a matter of minutes. It doesn't say, like, oh, Randy, who wants to make 1%? NASDAQ's up 30% this year, or whatever. I'll do 1%, and then I'll turn around and get it on the upside, and then I'll turn around. So if you can make 1%, and you can only do that, let's just say you did it, you were very patient, you sat, waited for your trade, which is a good thing to do, especially when you're first learning this stuff. And let's just say you only had one successful trade a week, making 1%. 4 weeks in a year, really 4.3 weeks in a year. I'm sorry, in a month. 52 weeks in a year, you're not going to trade all of them. Let's just say you traded 40 weeks out of the year. Okay, you took a lot of vacation, but you had net, one a week. Do the math. That's 40%. Yeah, that's a non-compounded 40%, by the way, which would be a whole lot higher if you compounded it. So that's what active trading is, and you're just getting these little swings in the same. And it amazes me, the same exact techniques and patterns and trend lines and support, resistance and breakouts and candlestick reversal patterns and divergences and overbought conditions. They work every bit as well on these short-term 5-minute, 1-minute, 15, 60-minute charts as they do on the daily and weekly. The thing about the daily and weekly, and when I cover those and I see frustration, it paints the big picture where the weekly charts are, you will build a bullish or bearish setup, divergences and overbought conditions and breadth deterioration, even things like that can be measured on those time frames. They will build typically for months, at least several months, but usually years. Usually it's a 15, 18, 20 months, 24 months until they play out. But when they play out, they change the trend and they play out for a much bigger move. So that's where, if I continue to repeat this, that's what formulates my longer term outlook. That and a whole lot of fundamental analysis I don't talk about all the time. Remember, that's my background. I was, business major right out of college, career stockbroker for almost 15 years. It's been so long. Immersed in the fundamental analysis part of it, and then kind of really self-taught on the technical analysis part. Once I fell in love with that working as a broker, it got to the point where I was trading so much that I couldn't. My compliance department said, you can't keep doing this. You're actively trading and it can create a conflict of interest. And because if I short Apple and then right after I take a client order, he says, Randy, buy me 500 shares of Apple. I got to buy the Apple, but then I turn around, or let's say I bought it that morning and then he told me to buy it. Then that's front running. They see that I made a trade ahead of a client, and then boom, you can. Anyways, it can't work. You can't do both. So that's where I left that business, and best decision in my entire life. So, all right, guys, these are the levels. You can trade it, not trade it, but that's the that's there was the setup there. Boom, boom. The arrow breaks are where you're likely to get reactions. So, if you're an active trader, you hit 430, you game the bounce. Now, I want to say once these trend lines break, let's get to that, because that's what everything to me is about right now. And we're testing them right now. And I'm talking a solid here. We'll go to the daily charts, so there's no confusion. That's the highest probability breakdown. We're on the trend lines right now. Again, I always say if you have to squint, and you also, don't take too much into opening order imbalances. It took a lot. It took a full percent just to get to the trend line. And I told you, I think they're going to go. I think the breakdown's imminent, and hence the reason somebody asked me the other day, hey, were you going to cover it? I said, no, I'm going to hold some little starter short on swing accounts. I'll still actively trade my active trading account, but this is where I'll add to. And we're right there now. So let's just summarize this so I can get the video out to you guys there. QQQ on the trend line, SPY just a hair above it. And the other two I wanted to see break were Meta below the and really on SPY and QQQ as well. As I've been saying, if you really want to play it safe, and I know a lot of this trend has been resilient. Believe me, it's one of the most resilient in a while. I've seen more resilient, but this is up there with it. In other words, meaning sell signals, breakdowns get gobbled up. But again, this one bounced where we expected to bounce. So I didn't expect us. It was possible we could have went through there and kept going, but I think the next time around we break it. And what I was saying the other day, the highest probability entries, if you want to wait till they clearly take out Tuesday's lows. But to do that, you're going to have to wait for another 2% drop. So, and again, the way you can do it is add to it. It's still not an all-in moment, guys. We are above all the major movement. We're even above on the daily charts, way above the 200-day movement averages. So, my thoughts. At minimum, I think the next swing tradable downtrend is going to, that's not my tool, swing us down, and at some point soon come in and test the 200 days and price targets that I have around that area. They're not on this board. But let me check on Amazon actually. See, Amazon it's flirting right there. 167.50-ish, that is the top of the gap. We pierced it, remember the other day, but we also hit the trend line. And so the safe bet is under Tuesday's lows, but once we start cracking into this again, it's probably going to give way. In other words, start to slide before we even get to Tuesday's lows. That's just again, I'm speaking in probabilities. And even then, please know this, even then, we can break the trend lines, we can break Tuesday's lows on SPY, QQQ, Meta, Amazon, and there are no guarantees. We could then turn around, it could be just a big fat bear trap, market could ramp up and go on to new highs. I don't think that's going to happen, but you need to be prepared for it and figure out where's your stop. What are you comfortable with? I mean, at the very least, let's just say, for example, what you wouldn't want to see on Meta, and the same thing with, we start entering the gap and then we go up and we don't just back test the top. I mean, there is another gap right here now, or I'm sorry, there's not. That's today's candle right there. But you wouldn't want to see us get really much above the top of the top of the gap on a kickback rally, and you certainly wouldn't want to see to go new highs. And if we do, depending on how the charts look, I'll let you know my thoughts at the time. But that's it. And again, should be pretty swift drops on these guys once they enter the gap. Let me show you a trade idea. This was let me go to the site here. Let me move this up. And somebody pointed out this one to me this morning. I haven't refreshed it, so just one of those kind of venting things about. Oh yeah, there's the chart this morning, the one I showed you to get out the. Remember, I haven't refreshed it to the trade the back test on the 5-minute chart of QQQ. This was yesterday. I posted an update on IWM in the comments section. Somebody asking if I was covering my short on the Russell, and I explained why at this time I'm not. I also have offsetting positions, indirect hedges anyway. So if the shorts, again, I only have on swing accounts a relatively small starter position anyway. I need to get those sell signals. What else this one. So somebody mentioned here this SMCI. I didn't even know about this stock. It's up 124 points, another 70. And I'm like, talking about this. So, and said that it counts, big part of the Russell is attributed to only this stock. And that's interesting too. The Russell is so diversified. I've looked at, in the past, I've looked at IWM, the components, and the Russell, which tracks the Russell 2000. And you don't have, the top components. Again, I'm going from memory, but they were like 2%, if that, no more than 3. It's not like the NASDAQ 100 where the top 7 stocks make up over, 50% or more of the entire returns of the index. And so it's interesting to note that this one, because of this, and I pulled the chart and I'm like, wow. And so in my reply, I said I was, initially I was like, you know what, I'm going to mark this as a trade idea, but I went ahead and shorted it. I shorted it at 1071, which was right after the open. Here, let me show you. I haven't even checked it since I started the video for you guys. SMCI. Oh, love it. Love it. All right, so beautiful bearish engulfing candle now. This is one of my favorite trades. If you guys remembered, I don't think anybody did other than maybe the person that threw it out to me. A few months back, somebody brought up orange juice futures to my attention. I can't even recall if I've traded them before. Last time I heard about orange juice futures was in the movie Trading Places in the 80s. I'm from Florida, big orange producing state. But anyways, orange juice futures have gone parabolic, and I just loves me a parabolic uptrend advance. So when you had this is unsustainable, and you can you do have a straight trend line, but you could also put a parabolic trend line there. Anyway, right now we have the bearish engulfing candle. So this morning it was up here. Geez, I didn't realize it. Oh, wow. It's been a nice reversal. Now, but here's the thing, guys. I'm not, my target's down here, 355. However, I'm not going to add to this one. It was a starter position because this thing was in an uptrend it did have the divergence I like to see on the 60-minute chart right there. So it had that, and that's almost enough for me right there. And it has this minor trend line. And I will most likely, there's the same as the uptrend line on the daily. I could and I should. I'm doing the video. If I was live trading, sometimes these videos do make me miss opportunities. I probably would have just covered, take the quick profit right there, and game the bounce and get back in, and then wait for break of the trend line. It's probably not too late. I just missed the bottom. It's bothering me a little bit. It's about a 16% gain in just a few minutes. But here's the thing. If and when we get those sell signals on the Qs, which I think today could be the day, or hammer down on Monday if we gap down, this guy's going to crater. This is just FOMO all over. I don't even need to look up whatever it was, whatever they reported. The market rarely mispriced as something so extreme. This was in this trading range and just broke out. It's a technical breakout, and that's what I'm, going to trade it back to, unless I active trade it out. Like I said, I would have normally maybe gained, at least covered that bounce, and then look to either reshort it, cover the pullback to the trend line, or look to reshort it back on a bounce or a break of the trend line. And again, I may probably add on a break of the trend line, but that would be from here, another 60%, and from again, thank you for pointing that out. That'd be about a 66. That's what I said in the post this morning. It'll be I'd like to see the stock, looking to see it cut 2/3 before I cover. So that's that target of whatever I just said here, 355 or whatever. Thought I put it in here. No, okay. I thought I shared my target. Anywho, that's it. It's a trade I did, but that's, guys, if you don't know what you're doing, be careful. And don't these things like this can just keep going. I'm not, I don't want to say fortunate enough, because no one wants to be older than they are. but I'm old enough to have lived through and traded. I was a financial advisor, but also had my own investments and working for clients during the 1999, 98, 99, well into that, the dot-com bubble. And the one thing, if you lived through that and traded through that, fortunately back then, I was pretty much a long side only. I wasn't shorting things. I was, like most people, only going long and did very well there. But my point is, do not ever underestimate how high something can go when you have one of these frenzy type trades. And we may have that in the market. We may be looking at a blow off top this year instead of a cratering like I'm talking about. I am fully open to that, a 1999-ish style. I severely doubt it. But what my message I'm trying to convey is, don't fight that. You cannot fight that on the wrong side of the trade, nor can you fight on the way down. If things go to where I think they're going, you don't want to be fighting that long. You don't want to be buying the dips. And I'll do my best to help navigate, where things go. It's been lately, like I said, at new highs with a lot of divergences and other things. I haven't been flooding you with long side trade ideas. I've got a few out there and they're planned out. Silver's doing well. Gaming it, and I post month updates, boom, yesterday, and we hit that target. And if you look at the chart I posted when we hit it, this is what I do. This is what I call micro analysis. I don't know if others do what I do. I guess it's part of an active trader. I just kind of learned my own thing over the years. So you can see the arrows, and that's what I did. And somebody asked, and I posted it. I shorted it there, gamed it for a pullback to the. Remember, once resistance, which was 2082, was a target we opened gapped above. Once broken becomes support. And so it doesn't look like much, but here's the trade. So all along, that was the first entry. And then remember, we hit that target, and that was an objective of time to book profits too and recycle back in here. Or as a swing trader, like I said initially, start buying here, scale down to, but not below 20. So your average cost will be down here somewhere. And here it is. So just in the last couple of days, silver's gone up over 5% since that last entry highlighted there. But if you're an active trader, you made buying it off the $20 support level and then selling it there, like the arrow showed yesterday, you made 5, and then that was a 1% drop. There's 6, and now add another buying back into at the 2082 support, another 1.6. So that's 7.5%, we'll call it, instead of what silver did. So that's what active trading is all about. And it's not always so easy, but I always say you miss 100% of the shots never taken. All you can do in this game is wait patiently for your setup, your trade, take your shots at objective entry points, and some are going to pan out, some aren't. Let's say we didn't, I bought back here and we didn't bounce there and we kept going down yesterday. Well, we probably would have stopped anywhere at the next support level that was a former target down to at most a gap backfill, and anything below that would have been an objective stop out, because even though the trade would still be profitable from here, the swing trade and active trade, it just wouldn't be ideal to see anything much more than a backfill. Okay, let me wrap the video up, but let me reiterate, because I haven't covered it a lot lately, but it was in recent videos, that and I've talked about it, if you go back a few weeks, the VIX really setting up. That's a daily chart. This is a weekly chart. And I covered it quite a bit in the past few months. You can go back. You can look under this post when it gets published. Underneath every post at the very bottom is a date, the time, and then the symbol tags, ticker tags. So when I cover whatever I cover in a video or even in a static post with screenshots, then I tag it with the symbols. So this will have $VIX. If I cover VIX futures, it'll be the /VIX, which is the VIX futures. And if I happen to cover VXX for those ETN traders, I prefer futures over especially ETNs like that, but I know some don't have it, so I'll try to cover it. And then I'll put VXX in there if I covered it, and I'll look at it real quick for you. But there it is. That's really good support. It meshes with what I'm seeing in the stock market, which is negative divergence. Remember, the VIX is pretty much a mirror inverse. And as I covered it back then, a few weeks ago, I told you my first target was 1545, which if you look here. We hit it 1, 2. You had 2 times to just swing up the VIX. And remember, you can't trade this. This is a spot VIX, but this is what you want to chart. What you can trade are VIX futures. You can trade options on the VIX futures, or you can trade the ETNs that buy. They buy the futures. They roll into the futures, and they have expenses and other things. And it's, in the long run, see, this doesn't look like the VIX. You're guaranteed to lose money in these ETNs, and even in the futures. They're hit and run vehicles. Hit, get out. It's not like an investment long term. But the spikes, and it doesn't look like much. This is all the decay, the expenses, the rollover. But when you get in there, and if you can hit these, that's 44%. So you can use VIX. And so if you want to know what it looks like on a 60-minute chart, we just see that's the decay. We don't see the VIX going lower like that, but VXX is. And that's why it's not a buy and hold vehicle. Where this will most likely explode or shoot up higher will be if and when we get those more significant sell signals I've been talking about. But even if you're a short-term trader, instead, in lieu of shorting QQQ the other day when we had the trend line breaks on Tuesday, and then that big drop on Wednesday, that was, let me make sure so you would have somewhere in here on Tuesday, this is right here, we got the sell signal that I gave you on the breakdown of the minor trend lines on NQ, on the futures, SPY, and that got us short for the pullback to the bigger trend lines. And so if you bought VXX there and then covered at the lows, because remember the lows was open, we hit the trend lines, that's where I posted covering my shorts, bouncing long, game in the bounce. That was a 14% pop one day. I need to be careful because VIX can destroy you if you don't know what you're doing. But you're basically just supercharging short trades. And when you want to, anyways, you want to, confirm that the VIX itself chart is constructive or bullish when you're going to take those trades. And like I said, this is the VIX. It's been making higher lows, spiking up, and so whether it's today, Monday. Well, by the way, Monday's a holiday, so if the markets are closed, I'll probably not be posting anything. Or maybe it's 3 months from now where we get a break of those trend lines or another sell signal, maybe not those trend lines. But at some point here, right now, the VIX is set to, and it has been moving higher, by the way. It has been moving higher, but it hasn't really taken off. You can see, you get these divergent lows on it. You had them back here. Here was a divergent low. COVID warned you COVID was coming, or a pop-up in the VIX was coming. There was a divergent low. And again, don't underestimate. These are huge. This is double. This is 100% plus run. That was a divergent low. And then you started. This was leading up to you got these spikes that were all tradable spikes. But ultimately, they got bigger and bigger. But as I mentioned, and I'm going to wrap the video here, one of many of my indicators, we didn't see. That's why I strongly don't believe October of 2022 was the end of a bear market, and rather just the initial leg down in a new bear market, because this is where bear markets end. This is where the last bear market ended that we had, the real bear market from the financial crisis of October of 07 to March of 09. The VIX spiked when the NASDAQ peaked down at the end, late 08. And it hit that same exact level when COVID hit. And that was a bear. It was 36%. It was quick, but it was a bear market. And this line here, I've shared this before, it's where since the Great Recession, since the last real bear market, this is where all, or let's say the majority, if not all, of the major corrections ended. And guess what? And I've covered this again in the past. In October of 2022, we didn't even get there. All that tells you is there was just no fear. There's this over-reliance and undying belief. It's almost like a cult following. Was it Jim Jones, the one with the guys that drank that's where the expression drinking the Kool-Aid came from. He spiked their Kool-Aid and killed hundreds of people. Cult following. That's what I think you have right now with Bernanke and the Fed, and just this undying belief that the Fed will prevent all other future bear markets. And even if we get a correction, just buy more or hold. It's going to So anyways, I'm just trying to show you the VIX by this metric and others that I've shared. We have not seen the ends. We're going to take out the by quite a bit, I think, the October lows. So, and I'll leave it at this. And I've said it before. And again, I don't mean to be. It's not my thing to be Dr. Doom and Gloom. But if and when, because I see that setup now where everything is so one-sided, sentiment, belief by the masses that that everything's going to be Goldilocks. We're looking at no landing, most likely. Worst case scenario now, some might still call for a soft landing. That rates are going to go down, but the economy's super strong and the underpinnings. And, when I turn on CNBC, the few times I do, that's what I hear them parroting. Oh, yeah, we might get a little pullback. But the underpinnings, this economy is very strong and healthy. And the indicators I'm looking at say otherwise. And the technicals that I sit here and talk about every day for 45 minutes on videos, and they tell me otherwise too, despite the current trends. So that's it, guys. You have the levels to watch, and we're getting close. That's why I wanted to get the video out early today. And there it is. Well, that's not my daily. There's the daily clean board. QQQ. SPY right on the line. SPY a little bit above it. And then we got Meta and Facebook. Meta's hanging in there now, and Amazon, Amazon teetering right on there on that gap. All right, so let me leave it here, because sometimes I sit and I only talk on one side, the side I'm expecting. If you are bullish, and I know you guys are out there, and no offense, I welcome you into other opinions, this is when you want to buy. I said it the other day too. This is when you buy. You don't short right now. You don't short Amazon. You buy. It's been defending this level like a champ, 167.53. I think it's going to go. That's why I'm not buying it, but I could certainly make a case to buy it and put a stop a little bit below. I'd have that stop probably right below Tuesday's lows. So for those of you that are bullish, you have the S&P 500, the NASDAQ 100, Amazon, and Meta, two of the biggest fangs, at or above very key support levels. So if you're not going to buy a dip, where are you going to buy it? This is again, it's a dip you can buy. And if maybe you're saying, okay, I hear you, Randy, but I also want to buy a deeper dip, then that's what I'll do. The same downside targets that I'm going to be looking, to profit on shorts with, and maybe trade a bounce off, will be levels that you may want to step in and buy if you do think this market's going to continue higher, at least for the foreseeable future. All right, I will wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.